Hello everyone, again it is Sterling here from Trader Dale, back for another video in this prop firm series. This one we're going to cover how prop firms make money. So this is a question that we'll get asked a lot, what's in it for them, how do they make money, and what does that process look like. So in general, the primary source of income for a prop firm is going to be the challenge, the cost of the challenge, and then people failing those challenges, losing that challenge, or failing that challenge, and then having to reset the account. That is the primary source of income for a prop firm. So simply put, they make money from losing traders. If we want to simplify it as much as possible, when traders lose, all that money goes to them, right? So when they pass the evaluation, when they, like with Top Step, for example, you pay $149 for a $150,000 account. If you went with that, $49 for a $50,000 account, but let's just say $150. You pay the $149, you activate it. Once you pass the challenge, that's another $149. Well, if you then wipe that account out, that $300 went directly to them. They spent no money, and that was how they profited. So some people do thousands of dollars in account resets a month. So it's a valuable business for these people, as most traders trade like cowboys. They think they can just go in and slap them buy and sell buttons and make money. So they make money off losing traders because most traders don't treat this like a profession. So as I said, as most traders lose money, they B-book everyone to start. Now, what is B-booking? Okay, well, B-booking is pretty simple. If you buy, they sell it to you. So your order is never going to live market. There's no order going to live market when you go to a prop firm. Even once you pass your funded account, that trade, when you buy, maybe you buy one contract of the NQ. Nothing was bought in live market. In essence, they sold it to you because they took the other side of the position. Now, nothing is done. They didn't have to take the other side of the position. It's just when the account, if it's a positive trade, the money came from their bank account. If it's a losing trade, the money goes to their bank account, right? Like that's just one way to think about it. So that's why they B-book everybody, because most traders are losing traders. So 95% of these guys, they're going to make money off of. What do they do for the 5%? Well, they have an A-book for profitable clients, which is typically done as a hedge of the aggregate in live market and or internal client matching. Okay, so a little bit more complicated here. So an A-book is, they've recognized you're a profitable trader. You have all the markers of a profitable trader. You do the things profitable traders do. They're going to likely A-book you at some point. What that means is they're now going to be hedging you against internal client data, or internal client orders. So if they can match internal clients, right, a buy and a sell, or the aggregate in general, that's a position where they don't have to go to live market. They don't have to pay a commission. They don't have to do anything else externally outside of their system. When there's a large pressure on one side, or long or short, however, of this A-book, they have to hedge that position. That's the point of the A-book. It's to hedge it. It's to have a situation where you're mitigating your risk, because remember, to the prop firm, for most of them, and not all of them, we'll talk about this a little more down the road, but for most prop firms, their biggest risk is the profitable trader. So how do they mitigate their biggest risk? Well, they identify them quickly, they A-book them, and they hedge the aggregate as a general rule of thumb. So after they've done internal client matching is just cheaper. There's no commission, no need to go to the live market. So if you are profitable, how are they dealing with you in that A-book system? What does hedging the aggregate actually mean? Hey guys, before we go on to the next point, I wanted to spend 30 seconds just to show you the Funded Trader Academy. All you guys are going to be aware of our self-study packages. That's the primary way people access Trader Dale. But the Funded Trader Academy is where you work directly one-on-one, essentially with Dale and our other team of prop firm funded traders. You're going to go into the room, you're going to see them trading live day in, day out. You're going to be able to ask them questions live, go over the market live, potential trade setups, have the ability to ask them questions after the fact, post trades, get video feedback on those trades. Really just a white glove hand-holding service, ensuring that you're making progress towards becoming a profitable prop firm funded trader. So if you want to learn more about that, you can click FTA in the main menu of Trader Dale. You'll see the ability to book a call. You book a call, learn more about the service, and see whether it's right for you or not. All right, guys, let's get back to the video. So just to kind of preface this, I wrote, The good ones, meaning the good prop firms, they're masters of risk. Worry about your trading and let them manage the risk. A lot of guys go, man, I don't like that they're trading against me. They provide a fair trading environment for you. They are managers of risk. Let them manage a risk. Worry about not taking 10 revenge trades tomorrow. Worry about not flipping and reversing 20 positions tomorrow. Like, you know what I mean? I don't want to be a smartass here, but that's your biggest hurdle that you're likely going to have to overcome. Don't be so caught up in the fact they're trading against you. Some of you guys get really caught up in that because when you are profitable, they're going to A-book you like this. Here's an example. Let's say their clients are 754 contracts long on, let's just say the NQ, whatever you want here, right? So as the market were to go up in their client long position, the firm would be losing money. The client would be making money, right? Because technically when the client's long 754 or whatever the contracts are, the prop firm is short that equivalent amount. So in order to hedge that, what they have to do is they take whatever they'd technically be short in this example, long if the clients were short, they would have to be long. So they hedge whatever their position is. So they'd go to live market and they would actually buy 754 contracts of the NQ. What would that do? So they wouldn't sell it. They wouldn't hedge against their clients because they already technically did that because the client doesn't go to live market. So they've already technically sold to the buyer or bought from the seller. So they have a negative 754. They're going to have to go long in the market 754. When they do that, that matches the open position of their clients. So again, when the market goes up, their clients are making money, they're losing money, but in their hedged position in the market goes up, they're long the equivalent amount. They're matching that amount. Now, there's some slippage in here. And there's also commission. There's also not a perfect hedge of the aggregate. Sometimes they're making money, sometimes they are losing. So what this is within that prop firm structure is there's that 10 to 20% for profitable traders that the prop firm takes, right? They only pay out 80%, some pay out 90%. So that 10 to 20% is that margin that allows for them to, within that hedge, it allows them to still be around break even or slightly profitable on their profitable traders. That's in essence what I'm getting at. Now, this is a very simplistic breakdown, right? These are professional quants that are managing very large sums of money, very large potential risk. They're very, very good at it. So some firms also produce alpha off their profitable clients. This is typically done not hedging directly, not trading with the profitable client because of slippage, market movement. It's just often not profitable. It's more done as getting the overall long short bias of your losing traders or of your winning traders and taking trades based on discrepancies between those two as more of the aggregate versus just trading with certain traders. So they're always looking to hedge risk. They're not looking to take the max upside they can. They're not looking to match all their profitable traders and go in, 10 times size and catch the alpha of these traders because trading's a business that has ups and downs. They're looking to have this type of growth. They don't want this growth. They want steady, consistent growth because that's what sustains over many years. So anyways, that's a quick breakdown on how these prop firms make money. Again, they're making money. The vast majority of the money is made through these challenges, through people taking challenges and then losing them. When somebody is a profitable client, they take them off that B book, put them on the A book, deal with them either by internal hedging against internal client matching or hedging the aggregate and then simply going to live market and again, hedging that aggregate so they're not liable for the risk of their profitable traders that are the ones making the money. So anyways, that's a basic overview of how a prop firm makes money and how they function and how they deal with losing traders and then how they transition once you are profitable and how you can still work with them and work with them quite well. So anyways, guys, that was it for this video. See you all back for the next one.